All right. So, Jack, I guess I'm just going to run then. So I've got some marketing issues and some crop insurance observations to go with it. Big picture, if we start with and I want to add, I'm going to get the pointer out here too. There we go.
Looks good. Can see it.
Everything is working well on this end too.
All right. So this is a snapshot of what Jack was talking about, and this just compares the price of corn at the U.S. level to the ending stocks to use ratio. And this is a collection of back in the 80s and 90s, or the blue diamonds down at the bottom, and then the last 20 some years or so are shown as those orange squares. And then the gray triangles up here are the USDA baselines, and those haven't changed. But what has changed in the interim between the WASD and the baseline is the Outlook conference numbers, and I'll show how those come into play. And for corn, watch this area right up here. So with corn, it shifted the current years over a little bit, and it added in or brought this observation right here into play. That's the 2023 or new crop projection level for price and ending stocks to use ratio. Now, I've laid curves or overlaying curves in here, or trends in here. Don't confuse this chart with the demand curve. It's not the demand. This is the residual leftover ending stocks as a function of use or disappearance through the year. So it's not a demand curve, and we would expect some. The only thing you kind of expect here is that it be sort of just gently curved or convex relative to price and stocks to use. So you'd expect some pattern like this swooping kind of thing over time. Why might the price continue to be very high for 23 if this is the stocks to use? Because if you'd follow this down, price would be down here typically with this kind of expected ending stocks level. Few things are a little bit different. You've got the pressure from renewable diesel helping soybeans stay high. You've got the South American exports that are different than over the last 20 years, and a little bit of inflation going on from the standpoint of corn has had a relatively high price, and as have all the substitutes. So you can't shift away from corn into something else without paying up for that as well. So that's where the 2023 sits, and that would still be unusually high for a price level. We'd expect something more down in this area if the stocks to use ratio recovers or improves or increases relative to the last few years. With soybeans, you get a similar type of effect. Here's ancient history for soybeans. The orange again would be the last 20 years or so, and the baselines follow that pattern there. So some difference, sort of shifting back and forth. If we throw in the Outlook conference numbers, very subtle, but we get that slight. Let's see if we can visually see that. Adding in the 23 puts it right here. So you can tolerate a little higher stocks to use and maintain a higher price on soybeans, and that wouldn't be crazy. But if you really increase the stocks to use, you'd expect the price to slide back down to much lower levels going forward. So that's kind of what's happened, big picture with corn and soybeans. And specific to soybeans, Jack and I have both been using different pictures trying to make some sense of looking at new crop, but then also looking at new crop. In this case, we're looking at soybeans here, for example. The open high-low close chart across the top is the 2023 new crop soybean futures price. Underneath that would be the 2024, and below that, the 2025 new crop futures prices. I'm not sure exactly the terminology to use for those, but you get the general idea. As these new crop prices have trended higher, or had been trending higher into the beginning of 2023. We've had some variability so far or year to date in 2023 for all three of those price series, but you may have looked at these higher prices and said, how can we or could a person take advantage of generally or historically relatively high price levels and do something out that far? You're probably limited in terms of the ability to forward contract beyond this year. So you might be looking at futures or options out for the 24 and 25. But you can see that as we've lost some ground in terms of price level in recent weeks, or really since the beginning of the year, not only has the 23 crop, but the 24 and the 25 crops have declined as well. Focusing from a few minutes now specifically on crop insurance and what's happened, where things have sort of settled out for crop insurance for 2023. We've got here the big three crops with crop insurance tied to them for corn, soybeans, spring wheat, and winter wheat. These are specific to South Dakota, but it is reflecting just the national price level. So we can see if we start with the maybe the outlier there would be winter wheat. The winter wheat was set back in September, and that price was actually higher. The projected harvest price for winter wheat was actually higher than the year before, reflecting the continued uncertainty with the Russia-Ukraine situation and the general outlook for wheat at the time. The other three crops, corn, soybeans, and spring wheat, all have a projected price for 2023 that's down slightly from the projected price from 2022. That the price period just ended, that is reflecting the average of the new crop futures price during the month of February for those three crops. So corn, for example, is sitting there at $5.91 a bushel. It's not an official announced price yet, but it's the price just the last 5 days for the month of February. That's what the price averaged. Soybeans is there at 13.76. So both of those price levels are down slightly. Soybeans down just a little bit more than a year ago. So price level is very similar. I think a slightly bigger change, something to take a look at, would be the price volatility. And again, I'll point out winter wheat on this chart is this is the volatility factor as reported by the RMA or used by the RMA. This dictates or drives your crop insurance premium level for the year. So winter wheat, at the time winter wheat insurance was purchased, volatility level was very high in the market. So up around 30%. And if we look at corn, soybeans, and spring wheat, last spring, and this would have been before the Russia invasion of Ukraine, but before then, you had this second year in a row where corn and soybeans had relatively high volatility levels. Spring wheat also had increased quite a bit last year. So 2022, you had continued high price level or an increased price level from the prior years. The volatility was high as well. This year, the price has stayed about the same, but the volatility down here on the bottom, you can clearly see for soybeans, it's dropped quite a bit relative to the last couple of years during February. Corn is buried behind spring wheat. They both have moved lockstep fashion from a relatively high level of springtime volatility or midwinter volatility to a lower level. So price level is Similar volatility has gone down, meaning premiums should go down a little bit for the 3 spring crops shown here. And that lower volatility, it's reflected from the implied volatility level in new crop option premiums. But that also means that recently the cost to lay off other risk in, from a risk management perspective, the cost to lay off price risk in general has been down relative to new crop for those 3 major crops. Digging a little deeper, taking a look back at what typically has been purchased in recently, similar story for corn and soybeans. So I just have a couple of additional charts here for corn. This is last year's South Dakota, just South Dakota, corn acres by type of crop insurance purchased, just shy of 100%. It averaged up or rounded up to 100% of the South Dakota corn acres last year were covered by revenue protection. So consistent with farmers looking to raise a crop, perhaps, or have the flexibility to forward price that crop through forward contracts with an elevator or cooperative, or use futures and have upside price protection on the revenue side, should they have a yield loss of some kind as well. So other types of insurance in South Dakota made up much less than 1% of the acres last year. It's not to say that's what everybody's going to do in 2023, but it is a snapshot of what has been the predominant type of insurance used, not just last year, but for most of the recent years. What about coverage level? Here's just a chart showing last year's distribution of corn acres insured in South Dakota across different levels of yield election. So what was your coverage level, your yield election coverage level? The predominant choice last year was 75% coverage. So 75% of your APH, your proven yield, was insured, or that seemed to be the level of insurance that most producers gravitated toward for corn and soybeans, and to some extent wheat. So with the price level being similar, you'd expect not a change or not much change in the coverage level. And in fact, with a slightly lower volatility level, it might mean premiums come down ever so slightly, which might imply maybe a little bit of a shift, a little bit of a tendency to move to an even higher yield election level for 2023. Looking again at corn, just to break this out a little bit differently, this shows projected prices on a bar level. So this first gray bar is a projected price. So last year, the projected price was about $5.90. This year, it's about $5.90 a bushel. The harvest price, so the price during October, averaged closer to $7 last year. We don't know what that price is going to average this harvest time. And then we can see also shown on here is the October cash price. So price received by farmers reported to the National Ag Statistics Service. So that's showing it's a reference price for cash corn, South Dakota, at harvest time. So that's what I'm going to use to refer back to for basis here. But just to show, with that futures price level $5.91, we'd expect some negative basis level, or take a little bit off the futures price to get to an expected cash price for South Dakota. So from an expected cash price level, it's going to be similar to last year, and very likely be lower if this pattern holds. A lower cash price would be expected. Also shown on here is just a repeat of the volatility level, showing that that's down from the last couple of years. Focusing on basis for just just a minute. So this would just be that NAS cash price less the average futures price, which is reflected in the harvest price from crop insurance. So last in 2022, that basis at harvest was about 45, 48 under. Of taking the average from 22, 21, 20, 19, and 18 gives you this average basis just shy of 40 under. So at the moment with say 550 new crop, take off 40 cents, expected cash price 510 would be how I would think about the math working out. But just to give you some idea of a reasonable starting point for a basis estimation for 2023. Soybeans, similar pattern in terms of expected price being similar. Harvest price has fluctuated a little bit relative to that beginning price just to see those, and then the cash price. So here for 2023 would be the expected cash price, and it's just the same general pattern. And if we zoom in on the basis there, basis has been relatively narrow the last 2 years on soybeans in South Dakota. And again, taking just the 5-year average, so the average from 2018 through 2022, I'd see basis to be still in kind of that 65, 68 cent under area for 2023. So take that new crop futures, say 13.5 and take off 75 cents or so, or 70 cents rather, and you can get back to an expected cash price. Real quick on spring wheat. Spring wheat had its last huge shock from the 2021 year, where the harvest price was finished much higher than the expected price. But that would not be the normal pattern. In fact, spring wheat had these 4 years and these 3 years where the harvest price finished quite a bit lower than the projected price. So with an unbiased futures market, you'd expect half the time the market to undershoot, half the time the market to overshoot the price level going from February to September. Volatility is lower in this market, and we've still got this expected cash less than the futures price, reflecting shipping to Minneapolis, Duluth locations, reflected in that spring wheat futures price. Here's the spring wheat basis. And normally this basis is a little bit narrower than some of the other crops. But we've had some extremes the last couple of years. So again, just taking the average from 2018 through 2022, you're just going to smooth out the unusually wide basis 2 years ago, the unusually narrow basis last year at harvest time. So that would be the August time frame. So August cash price relative to the September average of the September spring wheat new crop futures price. So that basis coming in right around 60 under. So you can take a spring wheat price from September new crop to board and back off, say 55, 60 cents to get to an unexpected cash price in South Dakota. Now, with soybeans and corn, a loose indicator that Jack and I have made a habit of sort of following. It's kind of interesting. This is followed and tracked at the national level. These prices have been observed at the national level, and then I've seen the analysis. In fact, they shared at the Outlook conference. They shared the analysis of what that means for the national picture of soybean acres relative to corn acres, and we have similar set of data for specific to South Dakota. First, let me just discuss what's happened here since harvest time. So September, October, November of last year until now, there has been a little bit of an increase or an improvement in the relative new crop futures prices, new crop soybeans divided by new crop corn. So if you've got really good eyes and you look up here in the upper left-hand corner, I just went into the CME's website and pulled up the soybean chart, and then you can go up and find an edit window and divide the new crop soybean price by the new crop corn price and build this chart yourself. Something fun to do on the weekends. There we go. But that price level since November has increased, and it sits here. Recently, it's gone up. The higher that soybean price to corn ratio, the more you'd expect, all else equal, a shift to soybean production rather than corn production. So what does that mean in terms of acres? If we look at what is that price ratio this time of year when the crop insurance election comes out? So I've taken that and cross-reference that to the soybean to corn acres level as reported by NASS, National Ag Statistics Service, in the prospective plantings report. So this doesn't say exactly what always happens, but this is the relationship of the soybean to corn price ratio from your crop insurance levels to the prospective plantings reports or the numbers that come out at the end of March. So historically, or the last few years, when that soybean to corn price ratio has been very high, up here around 2.5, 2.6, that means you'd expect almost a 1-to-1 ratio or soybeans to be 100% of corn acres. This year, with the soybean to corn price ratio at 2.33, so we start down here, find 2.33, go up, hang a left, run over here, we would see that our implied acres ratio this time of year, 0.87, or you'd expect 87 acres of soybeans for every 100 acres of corn at the state level, South Dakota. Ignores input costs, ignores all that. It just says over time, that's a rough estimate of what to expect. Some years it's higher, some years it's lower. That's just the base. So with that soybean to corn ratio much lower than last year, tilts the acreage mix probably to corn here in the prospective plantings coming up. The last related piece is just a general observation. There's been a growth in short dated new crop options. These options settle monthly to the new crop futures price. Might be a way to manage some short run price risk. It may have allowed some positioning prior to the crop insurance deadline. The volume in the March short dated new crop, which expired a week ago, that was before the insurance deadline. That seemed to have more volume than April, which expires afterwards. And then looking forward, I'll show a chart of this too. The May contract expires at the end of April, which is after the prospective plantings report. So if you've got relative to crop insurance, if you've got a situation where you've got you maybe tried to do something prior to the insurance deadline, now we know what the insurance level is, might do some marketing that way, but going forward or looking ahead, if your expected yield is much higher than your APH, you might have some bushels that are hard to have insurance on, but you'd still like to do something on the marketing side. Perhaps a short dated new crop option would fit in there. And then you might always have some level of marketing that you would want to do that would exceed your crop insurance bushel guarantees. So if you have 75% coverage, 25% of your crop is pretty hard to count against your insurance. So you might look at an option for your marketing plan out in that area. So short dated might be something to take and look into to see the trend in open interest. This is just middle of the month, November, December, January, February, the last 4 months. What's been the trend? we look at the blue, this is the trend in new crop corn option volume, or sorry, option open interest. So as we get closer to the time to market December 23 corn, we have an increase in use of or open interest of put options. This is specific to put options, downside price risk. So to capture sort of the trend you might expect to see from farmers hedging 23 corn. And then at the same time that growth has occurred, you've also had an increased volume of the short dated new crops options. So in fact, as a share of overall open interest in new crop corn, you can see that as of the middle of February, almost half of the new crop corn put option exposure was in short dated options. So just to throw that out there, something else to be aware of. There's substantial anchoring. This is a snapshot from the Chicago Mercantile Exchange of the recent open interest and volume in December corn regular American options. So this is the typical option open interest. The volume is shown below, but you can see for puts in the yellow, a lot of open interest around the $5 strike, the $6 strike, the $4 strike. For calls, there's a little bit of open interest at the $10 strike, and a couple out at the $15 strike. And the volume recently shows similar share or similar trading volume at the different strike prices or strike levels. That same anchoring at some of the more round numbers or round price levels that you'd expect carries over when we look at the short dated options. So shown here on the extreme right is the volume by strike price. So where you see the darkest green, that's where you've got the most open interest. So the $5 strike put option right here, 22,000 contracts of open interest. And you get a similar pattern when you look at going back from the September, the August, the July, the June, the May, short dated options. And then I threw in the newest edition from the Chicago Mercantile Exchange, weekly settling new crop options. So this was yesterday. So tomorrow, there is a weekly option that settles to new crop corn, Dees corn, and whatever the Dees crop corn price level is, that's what the weekly short dated new crop option will settle to end of or close of trade tomorrow. So just something else that's out there, might be something to take a look at as you try to manage your insurance level, lack of insurance level, and price risk for the year. Getting ready for Jack to wrap up, and we'll have time for questions here in CCA credits. My last slide, I just want to call attention to the fact that on the extension webpage, we have started posting some videos related to the Every Acre Counts program. So that's the URL up there on the top. You just go to the extension webpage, and under agriculture, we've got a link for Every Acre Counts, and we're starting to post and expect to add some more videos, sort of just snapshots, some interviews with some producers across South Dakota and their experience with the Every Acre Counts program. Some of them talk about crop insurance and marketing and general farm management concerns. So I thought it'd be appropriate to share with the Crop Hour audience here. That's what I've got for story today. Here's my contact information. Email's always fun, and look forward to answering your questions.